A very good afternoon, everybody. We are here with the April edition of Netra. So, just to give you a gist of what Sahil is going to talk about in his presentation, he'll start with discussing some very insightful data points on gold and some gold mining firms. Further to which, he will also talk about some other precious metals and commodities, and obviously about the stretched equity valuations, especially the SMID valuations. Finally, concluding with earnings growth in the Nifty 500 stocks. Sahil will talk about each of these points and a lot more in his presentation. And also during the course of his presentation, you guys can drop in your questions through the question answer tab on your screens below. And we'll collectively take up those questions. Over to you, Sahil.
Thank you and good evening, everyone. Thank you for joining in. And as you know that we release DSP Netra 5th of every month. And today we're going to discuss the April edition of DSP Netra. And these calls are also done every month for you so that we can have a deeper understanding of all the data points that we are bringing in. So this time, I think there are a number of new trends which are emerging in the market, and we are trying to address some of them, how they have changed, and what is the data looking like. As Pragati said, if you have any questions, you can put them on the questions tab. We will take those questions at the end of the presentation. So this time we're going to talk about gold growth, valuations, and some return dynamics. First, we'll go to precious metals. I think we've seen a new lifetime high in gold after quite a while, and it has taken gold a substantial amount of time to take out its previous high. And we'll slightly look at the historical gold price before we jump into this data. So if you look at the screen, you can see that gold prices made a high of about $870 in 1980s, and it took them roughly about 27 years to breach that high. In 2008, gold prices breached that high that it made in 1980s, and then it rallied up until about 1850 $1900. And after when it peaked at that level, it took it a long time for it to come back to those levels. And post COVID, we saw that gold prices rebounded and went to this range of about $1650 to $2000. It hovered in that range for a substantial amount of time. You can see in August 2020, and now in Feb 24, we have finally seen a breakout come through. So one very important observation that gold prices, whenever they breach their lifetime high, and if they are able to withstand that incoming selling pressure, usually the rallies last a fairly long period of time. That is what we've seen. From a cyclical perspective, if you look at the bull markets, this bull market from 1971 to 1980 is roughly a misnomer, largely because gold was not freely priced before 1971. And I will mention that in the slide that I'll show. Once it got freely priced, you saw this ferocious bull market take birth. So I'm not sure how to calculate this time frame. It's more uncertain. This bull market, which was again constrained by what central banks were doing. So in about 1999, Bank of England did one of the last auctions for gold that it did. It held the price lower. Once that auction was over, gold prices skyrocketed after that, and it did not stop for another 10 to 12 years, right? And and since then we've seen that gold prices for the last 10 years have been more sideways rather than going higher, and this is now the breakout is emerging. The key takeaway is that this is looks like to be a durable uptrend in gold prices, and it can possibly continue for an extended period of time. And similarly, we are seeing similar trends play out in silver, although the trend is not so strong. In comparison, silver is way below its 1980 peak. It has never broken that level. Even in the last bull market in 2011, silver was still lower than what it was in 1980. And it has not closed above $30 since 2008. So in some sense, $30 is like a Lakshman Rekha for gold prices from a pure price perspective. If it were to able to close above that level, then possibly you will see that some institutional short covering can take place and take prices higher. So that will qualify silver into a bull market. Although in rupee terms, I think it appears to have already qualified for a new bull market to have taken birth with a new lifetime high. And similarly is the case with gold in INR terms, right? So if you go back to history, one thing is very clear that silver is a very large underperformer when it comes to comparison with gold. And you can see that there is a very large difference from 1971. So 15th August 1971 was the time when Richard Nixon, temporarily suspended the convertibility of dollar into gold, what is now called Nixon shock. And if you calculate the returns from that day, silver has severely underperformed gold. But one notable exception is that in bull markets, silver outperforms gold by a very wide margin, right? So if we are in a bull market, then there is a possibility that silver could outperform gold in this bull market. Another important point is that institutional buying for gold is a very big factor for prices to do well. And if you look at the lower panel, you have two charts here. One is the price of gold in a dollar per ounce. In the upper panel, the price is normalized. So that's why some of you would be wondering why this price is different from what gold price is right now. It's starting at 100 in 1971. That's why it is different. It's showing you what amount of return it has made. In the lower panel, the price is as what it is right now. And the blue line is the ETF holdings of gold globally. You can see that in the month of March, for the first time, ETF holdings were flattish to positive after seeing sustained selling for a while. And our contention is that if gold prices indeed have entered a new bull market, we'll see an uptick in gold ETFs holding also, because I have explained in many previous sessions that gold prices are more reflexive than other asset classes. That means if when prices enter a bull market, a large institutional demand for this metal comes up, which is very unlike many other commodities, and which supports the prices even further. And you would have seen in the last 1 week, many global institutions have come out with $3,000 targets, etc., etc. We don't have any idea what is the upside target for gold, but this is a reflection of the reflexivity in gold prices, which means that when prices break higher, a lot more investment demand for gold comes in, and which helps the prices achieve even higher levels, and it remains absent for a very long period of time unless gold prices enter momentum. So I have explained this in previous sessions. Please do refer to those sessions. Second is the linkage of gold prices to gold mining companies. And on this chart, you have two lines. One is the blue line, which shows you the performance of gold mining equities, companies, gold miner stocks versus the broad MSCI World Equity Index. That is the blue line, which means that when the blue line is falling, that means gold mining companies are underperforming broader equity markets. When the blue line is rising, that means gold mining companies are outperforming. And you can see that gold's outperformance to stocks is correlated with gold mining companies' outperformance to stocks. But you can see that this correlation sort of did not play out significantly. The beta for gold mining companies got cancelled. It did not play out. And many of you have also asked this question that over a long period of time, even for 10 years, why are gold mining companies not outperforming gold, right? Why the returns are not coming? I will explain that very briefly here. So you can say that in 2011, it was sort of a dot-com movement for gold mining companies. They were doing so well. Taking an example of the bellwether, which is today, let's say, the Barrick Gold. I have written it here. It was enjoying record profitability. It was trading at 40 times forward multiples, 25% earnings growth. It was doing huge amount of capex. It was guiding for continuous improvement in volumes and high gold prices into the future. What happened after 2011? Gold prices collapsed. Oil prices, which is an energy input for gold mining companies, climbed higher to $100 in 2011, 12, 13 for 3 consecutive years. Oil prices were above $100 on a sustainable basis. That hit the profitability of gold mining companies drastically. Margins were squeezed. Sales growth fell. and they were doing capex, which became nullified, right? So most of these companies from very high profitability became loss making. By 2013-14, many of these companies were on the verge of a shutdown. And since then, most of the companies have been in a repair mode. They've been repairing their balance sheet for a very long period of time. And now the situation is that many of these companies are now net debt positive. That means they are sitting on cash, they don't have too much debt, they are returning money to shareholders, they have high dividend yield, right? The only thing missing from this equation is earnings growth, right? They are not enjoying very high earnings growth. And one of the reasons for that not happening is that um, gold prices did not move up, right? So I showed you the chart for last 10, 11 years. In dollar terms, gold prices have been flat. So they have not been able to enjoy higher earnings. What we are seeing now is very, very clear. Gold mining companies publish a number called AICS, which is all in sustaining cost. What is all in sustaining cost? The cost involved in mining an ounce of gold, right? So currently, mining companies are saying that they require roughly about 1350 $1350 or $1345 is the weighted average for most mining companies for their all-in sustaining cost. You can read about it more about what all-in sustaining cost is, but very briefly, if gold prices are at $2,300 or 2350 today and their cost is 1350, let's assume $1,000 is what the most efficient gold mining company can make in terms of profit. It's not that simplistic. It's an oversimplification. What I'm saying is, what is not included are taxes, overhead cost, the more capex that they do for increasing their volumes. That is, all those costs are not included in AICS, right? So if you want to grow your business, you when you pay taxes to the government, the overheads that you charge, asset write downs that you do, all of that is not included in AICS. So it's not an apple to apple comparison, but for an efficient gold mining company, this wide profitability, that means $1,000 difference between current gold price and all-in sustaining cost, has not been seen in the last 20, 30 years. What does this mean? This means that gold mining companies can enjoy high profitability if gold prices sustain here. How long do they have to sustain? Roughly about 2 quarters is what we've seen historically. If gold prices stay at $2,300 or $2,250 for 2 quarters plus, gold mining companies will enjoy very high profitability, and that most likely should start showing up in their stock prices. And you've seen recently there has been a slight uptick, but they are still underperforming. You can see this blue line. Gold mining companies are underperforming the broader market the most that they have done in the last 20-25 years. So they have a huge margin of safety. And if gold prices indeed have entered a bull market, I think gold mining companies can really do well. So this is one change which has occurred in market trajectory, and we think that this could be a material change for gold and silver. Um, the next is on rate cuts. We'll talk about commodities again. And maybe I think let's touch upon commodities, which is a more important topic. We've seen that commodity prices have also touched a new 52-week high, and oil, metals, some agricultural commodities like cocoa, etc., they have also gone up significantly. Our understanding is that most core commodities means which are demand driven, for example, oil, metals, some agricultural commodities. These commodities still do not have very strong footing in terms of the economic data that we are reading. So it does appear that precious metals, which is gold and silver, are possibly the better bets across the commodity universe than other commodities. For other commodities, I think we are still in a very patchy environment. We'll have to still wait and watch to take a call. So it's much better to look at the data for precious metals and score that that segment of commodities are possibly looking much better in comparison. The other segments still do not have the kind of data support that will give us confidence that this is a sustainable uptrend for those commodities. So we'll probably wait and watch in terms of metals and oil and gas. But for precious metal, it does appear to be a stronger trend. The other one is that why am I saying what am I saying is that interest rate hikes are now playing out and showing up in numbers. Currently, you are seeing that most central bankers are in a wait and watch mode. Okay, so we looked at past data and we looked at this table. What does this table show? This is the interest rate hikes done by Federal Reserve. The first column is the first Fed rate hike, and the second is the last Fed rate hike. These are the dates. So, for example, the most recent one, the Fed started increasing rates in March 22, and the last rate hike was July 23. So, so currently, roughly in July 24, we'll have 12 months, right? So we are close to about 9-10 months of rate hike cycle, which is also very, very long. Cumulatively, interest rates have been increased by 525 basis points. Historically, whenever the Fed, raises rates and the last rate hike happens, 16 month on an average from that period, US has entered a recession. Okay, this is the historical data. It has got no, let's say, forward-looking or forecasting ability. This is what has happened in the past. Okay, so now in the next 6 to 8 months, we'll enter that period of that average period where monetary policy begins to show up in economic data. Okay, and now when you hear what central bankers are saying, most central bankers are saying that if everything is fine, if inflation is okay, growth is strong, why should we cut interest rates, right? This is the general consensus which has emerged over the last 1 month. And historically, we've shown that central banks have cut interest rates only if there is some sort of a crisis or trouble period which emerges, right? Whether it is domestic or global, whether it is a Lehman Brothers crisis or some, COVID-led decline or IL&FS in India, etc. Some sort of a crisis prods the central bank to cut interest rates. And interestingly, most of these rate cut cycles are also accompanied by decline in equity markets rather than increase. What is the current consensus? The current consensus is that Fed will cut interest rates. Because they are going to cut interest rates, equity markets will rally. History is not so kind. History doesn't show that it happens like this. Most rate cuts, as what most central bank governors are saying today, happen if there is a problem. Otherwise, they don't have any incentive to cut rates. Even if they cut rates by 25 basis points, they're going to wait and watch. They will say that we have cut once, let's wait for another 6 months, right? So they are not going to deliver any significant rate cuts. So two clear conclusion. One, we are entering a period where economic activity begins to get impacted by higher interest rates, strong, tighter monetary policy. We are entering that period now. Secondly, most central banks are in a wait and watch mode. They want to see some signs emerge that they need to cut rates. Historically, those signs have emerged only if there is some unseen event when it occurs, right? That prods the central bank to cut interest rates. And usually those events are not very kind for equity markets. So we are sort of in that period over the next 6 months to 8 months or 6 to 9 months, where you have a number of events, India, global, and this monetary policy lag period getting over. So the idea is that it could be a more volatile phase that we are entering from where we are today, and we have to be cognizant of that. Now we'll talk about the number of factors in India and some of the data that we are watching. And recently, what we noticed is that India has now become 2/3 of global trading volume. And these are volumes, the number of trades. In terms of value, also, we are not very small. We are barging in about 1/3 of the global value, also, which is very, very high. What does this mean? Out of every 100 derivatives trade put on a single day, India accounts for 66% of them, right? And a lot of it is more speculative in nature. I'm sure that not many equity derivative contracts are used for hedging. A lot of it is also speculation. So these numbers appear to have increased substantially. You can see India's share has gone up from a low 10, 11, 12% to about 66%. I don't think any other country has shown these kind of trends historically. Maybe it has shown, I'm not aware, but the data that I have seen has not shown any single country account for such high volumes, increase in high volumes. Of course, United States has always had a large share of derivatives trading, but you can see that now we are sitting at 66% in terms of volume, which is very high. Even cash volumes have gone up significantly. You can see overall cash volumes in domestic market. It tells you that overall participation has gone up significantly. And this data particularly tells you that a lot of that participation is more speculative in nature. And if you go back to the last Netra and the edition before that, we have also shown how strategies tracking option selling have the highest share or the highest AUM that we've seen over the last 6 to 7 years, which is a global phenomenon, not an India phenomenon. It is happening globally. What does it tell you? We have used this term earlier also. Sort of an unsettling calm, where market participants believe that nothing wrong can happen globally. And these sort of data points are available only in real time, and they do not have any forecasting ability, right? You will never be able to judge a trend using these data points. But what do they tell you? They tell you that markets are not prepared for any sort of uncertain or a shock which could be delivered. And we've seen that shocks are more repeat, they occur more often than not. And when participants are not ready, the damage is higher. And these data points, therefore, are sort of put you that alarm in your mind that you need to be careful in terms of how you allocate capital when times are so good. The next is an outlier, and let me use that word again. We have shown, I have also written it online about it, that there are a lot of similarities with 2017 and certain other bull markets that we are seeing now. And we have named it like an unsettling calm, right? A period of such calm that we have not seen from quite a while. And I will quote some of these numbers, which you can go and check online. They are freely available publicly. One such number, if you see, these are the institutional fund flows from FIs and mutual fund flows. You can see in 2023 calendar year, both were at $21 billion roughly, right? Which is cumulative $42 billion coming from mutual funds and FIs. And as you can see, historically, except 2017, we never had such strong flows from both these entities together. If you add DIs, for example, insurance companies and another large building will stand here, right? Very strong flows from all institutions put together. What does this mean? Such strong flows from institution, and also retail participation has been high. It causes the valuations to get stretched, and that is what we've seen the whole of 2023, right? And specifically in the small and mid cap space where valuations have gone up. What other unsettling calm indicators we've shown? We've shown volatility indicators earlier in the previous edition. In the Feb edition, we showed how decline in stock indices have become very rare, which is again a very unsettling calm. Another indicator I'll tell you that USD INR volatility or Indian rupee volatility is now one of the lowest. So if you, let's say, sort the least volatile securities globally, in the top 10 percentile, USD INR will feature, which is like we will have to go back to 1995 to find such a place. When you look at the forward premium for currency, very low. It shows a very calm market. Look at the AAA, AA bond yield spreads in India, very calm. Nothing is happening, right? So FX, money market, bond markets, equity markets, India VIX, all of these readings are extremely calm. We haven't seen this combination for a very long period of time. Again, I'll tell you that they do not have any forecasting ability. Okay, when you see these markets are very calm, it does not mean anything that something will occur. What does it mean? It means that markets are unprepared for any shock or unforeseen event, and they are sitting at extreme valuations, right? So when you are expensive, unprepared, if you get an external shock, for example, let's say oil rallying to $150, the markets will not have the ability to digest it other than correcting very sharply. This is what we mean by being very careful about unsettling calm. And we'll show you some more slides on, where it is showing up. This is another global slide. We have shown this indicator VMF earlier also. Some of you might remember we gave this indicator a clear turn when it had hit close to 10-15 year high. We had used this indicator saying in 2022 that markets could be bottoming out and there could be a period of strong rally ahead. And now we are at the opposite end where the indicator has cooled off significantly. And when you break it up, you will see that the volatility component coming from equity and FX. So this indicator is a combination of three markets: equity volatility, which is VIX V, move, which is bond market volatility, and FX, which is F, which is FX currency market volatility. This is a combination of all the three. And currently, if you account for the regime shift in the bond market where interest rates have gone up, VIX is at one of the lowest readings that we've seen, right? VMF is also at one of the lowest reading, accounting for the regime shift in interest rates, which means that markets are sitting on very, very, calm surfaces. And these again are readings which are, historically have coincided with very calm periods. But if shocks occur, markets sell off rapidly, right? This is what the indicator shows you. Once again, no forecasting ability, but it has the ability to tell you that you should be stepping back from taking more risk. You should be thinking more about asset allocation and protecting your portfolio. We look at three slides, particularly on India valuations, which are very, very useful. First is, what is the median mid and small cap valuation at this point in time? So when you look at stock number 101 to 500, which is small and mid cap space, you will see that the median valuations in 2007 peak was 20x, right? That median valuation rose to about 40x. Right now it's at 37x. And maybe this data is still 31st March. If you draw it for the last 15 days, it will be back to 40x. So we have double the median valuations what we had in the past cycle for small and mid cap, which gives you very little comfort in terms of margin of safety, right? You will have to be purely bottoms up in identifying ideas in SMID. At a broader level, they have become quite expensive. Secondly, if you look at the small and mid cap market cap to GDP, is at 52%. Okay, this is higher than what it was in 2007 on a cumulative basis. Even if you compare other more qualitative factors like ROE, when this 47 peak was reached, the average ROE of SMIDs was upwards of 20%. At the peak, it was 23%. Today, the average SMID ROE is close to 14.5%, 15%. Okay, which tells you that even the quality of earnings is lower than what it was in 2007 cycle, although the market cap is much higher. This tells you again that they have come far away from their long-term average of 29%. This is only small and mid cap market cap to GDP. If you add large cap, we are closer to 130%, right? In terms of market cap to GDP. It's a debatable indicator. We'll try to put more nuances as we go ahead. But this is a very useful indicator when you look at small and mid cap stocks. It tells you that it's clearly overheated. The last one is India market cap to money supply, right? So M2 is roughly the overall money supply in the market, not accounting for credit growth and money multiplier, but roughly, all the deposits which are there in the system account for M2, whether they are at post office or at banks, and all the demand deposits. And currently, that value is close to 65 lakh crores for M2. And India market cap, when we made this chart, was close to 390 lakh crores or so, about 6 times, which is the second highest level that we've ever seen. Last time we saw this level was in 2007. Again, it tells you that whenever market cap to M2 is so high, usually forward returns are much lower. Okay, and we've seen that the opposite played out. Last time, those of you who were attending these calls in, let's say, December 22, January 23, we were highlighting that these indicators are low, and it tells you that forward returns could be higher. Now they have flipped. They have gone to the other extreme, right? Which tells you that it's more prudent to be cautious from this point in time. Last few slides are on earnings growth and tells you why India has enjoyed such a strong run. And you can see that profitability has been very strong. So all the valuation increase that we've seen and returns that India has made, it has not come without any reason. There are very strong reasons. And the strongest of all is very, very sustainable and strong earnings growth. And if you look at these blue bars are BSE PAT growth, YOY basis. What is the change in profits? And red line is the nominal GDP growth. You can see that PAT growth in 2007 cycle was outperforming nominal GDP by a very wide margin. It's a bull market phenomenon, right? Whenever you see PAT growth outpacing nominal GDP, markets enjoy it. They do very well. Even in 2017, you can see, even in FY10, where market, doubled from their bottom, you can see profit growth was much higher. But in most other years, you can see profit growth is lower than nominal GDP growth rate, right? And that is how they catch up over time. Right? But recently, what we saw that the 3-year differential between profit growth and nominal GDP has reached 14.2%, which is very close to our lifetime high of 15%. That means profits have grown at a clip which is as fast as what we've done historically, right? One of the fastest pace that we did was 15% differential. We are back to that level. Now the question is, can we continue to do it? Okay, this is the holy grail question, and we have tried to answer that with some parameters, and it looks difficult, right? Why does it look difficult? Because top line has slowed. I showed in the last Netra that margins have peaked out, and you need oil at $45 to justify margin expansion. And unfortunately, oil has come to $90. So all the corporate profit margins that we were seeing have possibly already peaked out, right? So that also gives you another indication that this kind of differential earnings growth is going to be very, very hard to continue. And that tells you that possibly you should tone down, your returns expectation from the market and possibly be prepared for some decline. The next is a very telling chart in terms of, again, a reason why Indian markets have done so well. Earnings growth has been very, very strong. And we put out earnings multi-bagger, stocks where not only stock price, but the profitability, the earnings have doubled or more, right? So there are many companies where the EPS growth rate has been very high, right? Over the last 4 years, the absolute profit growth has been more than 100%. Companies doubling their profits or more. There are a number of companies, 94 such companies we've looked at in the top 500 companies. But one very interesting data within the small cap space, out of 250 companies, there are a large number of companies where the EPS has degrown on an absolute basis. That means 100 has become lower than 100. Whether it is 99 or lower does not matter, but it has not grown. Although many such companies are showing excellent price growth, right? That is where the dichotomy is, and that is where the risk is. All those companies where profit growth has been in line with valuation, they will continue to do well or possibly decline less. But wherever their profit growth is lower or negative and stock price growth is stupendous, those are the pockets where the risk is very, very high. And those pockets are not small. They are widespread across small cap, mid cap, and somewhat large cap. But it also tells you that majority of companies where earnings growth has taken place, the quality has been very strong. And that is one of the reasons why India trades at a premium. And as I said in the last slide, for us to continue this kind of profit growth, it is going to be very, very challenging. And signals that we are watching tells us that profit growth could actually slow rather than, quicken or fasten. The last slide is number of companies reporting losses, and you can see that we are close to record lows. This is 1%, which is also one company, which is a extraordinary item. This number is effectively 0%. No large cap companies reporting losses, which is very rare, right? And very few small and mid cap companies are reporting losses. Again, a very rare event that happens in India. Now the question that I ask myself is, why is this the case? Have Indian companies or most of these companies become better companies over the last 3 to 4 years? Maybe the answer is yes, maybe the answer is no. But one answer is very clear, that business environment has been very conducive. And that is the reason why number of loss-making companies have drastically declined. It also tells you one more thing, that business conditions are cyclical. That means if conditions are great today, they can become bad in the future. And that is what the whole idea is, that right now we are sitting at one of the best business cycle conditions for corporate India. And the question that we should be asking ourselves is what comes after best, right? Usually not so best, and that is what we should be prepared for. That is what we should look at. And I will conclude here. I'll give you one very clear conclusion that equity markets from a mid and small cap perspective appears to be pricey. You have to be very careful in allocating, largely using staggered purchases, looking at bottoms up approaches or portfolios which are respecting valuations in small and mid caps. Large cap appears to be favorable on a relative basis, but on an absolute basis, they are also expensive. Alternate assets like bonds, gold, and silver, they appear to be much better placed in terms of risk reward. And you should, analyze them to be part of your portfolio and trying to up your allocation in those categories.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.